Hi, I'm Chip Stites, and this is the Laughing Retirement. In today's video, we're going to cover what 2024 will look like. And then last, we're going to take a look at a review of our 2023 performance and our portfolio. I have re-recorded this because I made a small error, a math error, on one of the slides. And so what you're going to get here is a re-recording because of that error. There you have it, putting 2024 in focus. So what are the three main things that we're looking at this year? Well, first of all, we've got a presidential election. Presidential election is going to be, to me, unique. And I'll tell you why. Second thing we're looking at is the Federal Reserve and interest rates. Interest rates are 3%, and they say they want them down at 2%, but it's an election year. So let's see what happens. Third thing is we got a MOMO market right now. We've got a momentum market. Now, does that mean we've got an economy that goes along with it? Markets can go up without economic conditions behind them, and we're going to talk about that. So let's keep going. Twists and turns, an unusual presidential election. The Democrats are scared of Biden's current age and deteriorating condition. Their vice president is not going to happen. It's a no-go. You've also got some people already committed to running: Dean Phillips, Marilyn Williamson, Tim Ryan, former congressmen, who are in the process of running. But I think you have things behind the scenes which make it even more interesting. For instance, there's a guy who runs the governor of California, who's the governor of California, and he's been running around to foreign countries, meeting presidents, et cetera, et cetera. Governors of states don't usually meet 6, 7, 8 foreign presidents. Something's going on there. This could be interesting. You could get to the convention and have everything you think you're doing turned on its ear. Let's talk about the Republicans for a second. Their main candidate is under heavy judicial, political, and tax fire. Enough suits and enough time and enough getting dropped out of races, and that could make difficult for the perceived presidential candidate for the Republicans. So there are alternatives waiting in the wings, but that picture's awful murky. And then you've got something that really makes it interesting. You've got Robert F. Kennedy Jr. running as an independent. Now, what does that mean? Well, let's see what happens. Let's suppose that he has no name recognition problem at all. Everybody knows the Kennedy name. Everybody. So let's say he siphons off 10 to 20% of the vote, and nobody else is able to get the required electoral votes in order to become president. Now you've got election in the House of Representatives. Now it becomes interesting because the political action committees of the political action pots, if you will, the place where people are allowed to put money, or corporations are allowed to put their money for candidates, they're going to grow like never before. You have a presidential election that may be out of the hands of the ordinary electorate. We'll see what happens. This year is going to be interesting, I think. We've got a MOMO market. We really do. But at the same time, we've got a so-so economy. Let's take a look at that. We're liable to see new highs on the Dows, the S&P 500, the NASDAQ, and I hope the Russell 2000. The Russell 2000 being the smallest 2000 stocks need more money. They're the smaller companies that I think are a better reflection of how the economy is actually going. And right now, the Russell's moving. And that, to me, is good. But the economy itself is iffy. Why is that? Well, yes, economic growth was just revised up from 4.9 to 5.2% for the last quarter. But if you look at that, it was government construction and fixed investments that actually went up. At the same time, private consumption and exports were down. That's not, in my book, a particularly strong economy. That's government money up, fixed investments up, but the average consumer getting cramped with inflation and the other things that are happening, those things, and our exports to other countries are down. So you turn to the Fed. And the Fed always says, well, we don't want to be political. We are not political. Horse feathers. The Federal Reserve, if they were non-political, they just wouldn't touch interest rates this year, but that's not going to happen. There's no way. The second step in non-political will be actually to raise rates. But when you raise rates, you take money out of the economy, out of consumers' pockets, and people vote their purse, people vote their pocketbooks. That would be running against the current administration. Lowering rates puts more money in the consumers' pockets, and that would help incumbents. So what's going to happen? I've read one account or one idea by a well-known money manager who says the first half of the year, you can look for the economy to continue along as it is. Rates may go up a little, but probably not. And we're going to continue this Momo market. But the second half of the year, you're going to see rates come down. That would be logical in a presidential election. It's not particularly abnormal. And most of the time, the stock market in a presidential election has a good year. So whether or not the Fed wants to stick their hand in this thing and actually try to do what they say they're going to do, which is lower inflation from 3% to 2%, which requires raising rates, that'll be interesting to see. Whether or not we get to the last half of the year, right before the presidential election, say June on, and they continue to raise rates, that'll be interesting too. So we've got a kind of a cloudy, murky picture, like the picture you're looking at right now. Not quite sure what's going to happen. This will be interesting. Now, let's take a look in the rearview mirror at 2023. You see, I believe in Aesop's fable, slow and steady wins the race. I also believe it's the long run that counts, not the short run. And I believe in simplicity, also known as Occam's razor. When you have multiple problems and multiple possibilities going on, the simplest answer is usually the best. So let's take a look at 2023. Well, it's obvious if you look at this chart, the pie, my portfolio, all the way over on the right-hand side, I didn't have a good year. Maybe, maybe not. You see, the S&P 500 did 24%, the Russell did 15%, the NASDAQ did 43%, the Dow did 13%, and a 60-40 portfolio, 60% stocks, 40% bonds, did 17, almost 18%. I did 0.22%. Not too good. But now, let's take a look at what happens when you use less risk, when you have high dividends, you try to buy at good prices, less risk, higher dividends, a more consistent return. Let's take a look at 2 years versus the perpetual income engine, or PI. The S&P 500 in 2022 was down 18%, the NASDAQ was down 23%, the Russell was down 21%, but the PI portfolio did 3.83 plus. In 2023, the NASDAQ was up 24%, the S&P was up 24%, the NASDAQ was up 43%, and the Russell was up 15%. The PI portfolio, 0.22. So if I did the averages of those, and I looked at it, and Well, that's relatively simple. The average of those of the S&P is 3.25. The average of the Nasdaq is 4.84. The average of the Russell is minus 3.24. The pie portfolio average is plus 2.03. So if you rank those, you'd say the Nasdaq was first, the S&P was second, the pie was third, and the Russell was fourth. You'd also be wrong. Why is that? We depend too much on averages. We look at averages as though that's the result. When you're going into retirement and you've got 3 to 5 years left in retirement, you don't want averages. You want good year after year after year after year. When you're in retirement, you don't want an average because an average is made up of things that go up and down. The average is here, it goes up and down like this. So let's take a look at the numbers. Always do the numbers. So if you do the dollars and you start out with $1,000 and you lost 33.74 the first year, like the NASDAQ did, you wind up with 662.60. But then the second year, you made 43%, 0.4342. 43%, you multiply the 662 by 43, you come up with 287. 662 and 287 is $950.30. Even though the loss was 30% less than the gain, you still lost money. Because it takes a heck of a lot more to gain over a 30% loss than just 40%. That's why Warren Buffett says rule number 1, don't lose money. What's rule number 2? Don't forget rule number 1. S&P 500, 22 lost in 2022, lost 18%. That leaves us with $818.90. The next year it gained 24. That gain is $201. $201 and 818 is $1,020.35. I keep saying this over and over and over again. Less risk and more consistency is better for your portfolio than high risk and see what sticks on the wall and what happens to you. I would rather have a consistent 6, 7, 8% return with 20, 30, 40% less market risk than I would have a portfolio that goes like this. Because I guarantee you, in the long run, I'm going to win. And if you do it this way, you're going to win. Let's take a look at the pie portfolio. First year, the pie portfolio made 3.38%. On $1,000, that's $1,033.80. The second year, last year, 2023, the pie portfolio did 0.22%. Nothing terrible, you say. It did a whole $2.27. If I take $2.27 and I add it to 2022, which is $1,033.80, I come up with $1,036.07. So who did better? The NASDAQ? With all its risk and up and down? The S&P 500 with less risk but more consistency? Or just the thing that consistently puts along all the time? Do the dollars. That's the only way to make sure your portfolio works. Having your financial advisor hand you a sheet like I did for 30 or 40 years and say, well, here's your average, 15%, you're doing really fine, and your mutual funds are in the top 10 of all mutual funds, you're doing great. When if you read John Bogle's little book on common sense investing, which you should do, he'll tell you the returns you get are not the same returns in the dollar sense that your percentages of mutual funds say you are getting. The dollars are different than the percentages. Here's an example right here. And I can show you this over and over and over again. So what happens? Well, over 2 years, you would rather have the more consistent returns You would rather have less risk and you wind up with more money. I say this to people over and over and over again. And they look at me like I'm nuts. I put this in chat rooms and people say, oh, I'm going to make 10, 20, 30%. My Tesla's up 100%. I don't care what your Tesla's up. What did your portfolio do? And what did your portfolio do in 2022 and 2023 and 2021? Consistency has tremendous value at a time when markets are terribly inconsistent. So what should you do? Well, remember Buffett's rule number one, don't lose money. And remember always to go back and put things in terms of dollars, not in terms of percentages, because that's your money. You can't spend a percentage. You spend dollars. That's what you spend. If you'd like to talk about this, please email me at info@thelaughingretirement.com. If you think you might like this method of managing money and having your money managed this way, I have a close friend who I consult with who manages money in this manner, and he manages it for 60% less than you're paying right now on average. So what are your choices? Well, number one, email me at the info@thelaughingretirement and ask any questions you want to ask. Number two, I can give you a free 20-minute chat. We'll sit there and talk about whatever you want to talk about. Your portfolio, the markets, what you're doing, et cetera, et cetera, et cetera. If you disagree with me, I'll sit and talk to you. I got nothing to hide. Info@thelaughingretirement. You can also look at our videos, look at our master classes, see how you feel about what we are doing, and if you like this style of investing, and if you like my way of helping people understand what they're doing, maybe you want us to manage your money. Maybe you want to take the course yourself and eliminate me altogether. After all, that's the purpose of this. Make myself redundant. Info@thelaughingretirement. I want you to look at the series. I'd like you to subscribe to the series so you can find out when we have new videos coming out, which we do all the time. Info@thelaughingretirement. I'm Chip Stites. This has been 2024 in focus and 2023 in the rearview mirror. Have a good year.